Yo, what's happening all? It is the 9th of January 2026 and a lot of shit to talk about. I'm going to try and make it as quick as possible. But the one thing that's really, really freaking cool about this, it shows I'm right. And I'm not trying to be an asshole about it. It's not being an asshole whatsoever. But all these mortgage guys keep saying, oh man, they're going to get better. They're going to get better. And they're not. And they keep staying the same and moving sideways. And they're just not reaching those points. I've been screaming since 2022 when I figured this out, or 23, what was going on here. And that it was going to take specific moves to make the interest rates move, the mortgage-backed security. Everybody's talking about the 10-year, all these things. So let's get into this, but let's talk about a couple other things first. So earlier this week, we have Trump saying that they're going to ban large investors from buying homes. So your BlackRocks, your State Streets, your Vanguards, those guys. So that right there is all over the place. Just showing you that I'm not bullshitting you. I'm not making up. They're looking to ban large investors. What does that mean? If you're banning the large investors, now it could be, there is speculation that how that works out, if it does get put in place, that they don't have to sell what they have, but they can't keep buying anymore, right? So that could affect prices, bring them down a bit. That's what some people are speculating, but you need more inventory and less demand. We still have a demand. People are still looking to buy these homes. So because they're looking to buy homes and they don't have to compete with the institutional investors so much, there may be more on the market for them to buy potentially. So that may bring some prices down. But then what else is happening? Well, before we get into that, we have today the Supreme Court is supposed to be ruling on the tariffs. That could be a whole other mix of crap within the economy if that rules negative for the tariffs. I don't think it's going to go that way. I hope it doesn't go that way because it looks like it's actually doing some good. We have actually our trade deficit completely swapped. It's not near what it used to be. There's a lot more going out than coming in now. That's a very good thing for our economy. So look at that. It's interesting to see a lot of these people and CNBC and others that are standing on Wall Street. Like, we don't understand how this trade deficit information is really coming out and hitting this way. And it's old data. This is a couple months old. I can imagine where we're at now. We're probably in a much better place. But this is what is the big thing right here. Let me show you this. This is monster because it tells you exactly what I've been telling you, or at least it proves what I've been telling you all along. Trump announces a $200 billion bond purchase to bid lower on mortgages. So he right now called for the purchase of $200 billion in mortgage bonds. So the MBS, not the treasuries, guys, the MBS, the mortgage-backed security, to an effort to decrease the rates of home loans and to decrease those costs. So what did that do? Literally yesterday, I'm going to show you. Let me see if I even got it. I was showing this to my team, that we actually had the market was sitting here stagnant right at the top of that channel that I keep talking about. I keep sharing with you guys all the time, sharing this channel constantly, keeps hitting the top of that, hitting the top of that, hitting the top of that, keeps just banging on it. It's not getting up there. And then at the end of the day, let me see here. That was the one I just showed you. Bam. It jumped. I'm like, what the hell happened? How did it jump? Why did we see that jump? It doesn't jump like that for nothing. And that's when we got this right here, where Trump had said that he is going to be instructing representatives to buy the $200 billion in mortgage bonds. And that happened yesterday afternoon. That's when we saw that. I'm going to show you that right here. This is what I had received. I'm like, oh, crap. Okay, so that was yesterday at 4:37 p.m. Eastern. That's when that went out. That is literally right before the close, and bam, you had that jump up in the bonds. So what I've been saying all along, the only reason they're going to push those things up would be if mortgage-backed securities started getting money themselves. Take a look at this today. This is what I'm talking about. Big old jump up into it. Look at that monster jump. Opened here, went screaming up into it, literally 50 basis points, and pulled right back down. Actually, it was more than 50 basis points. It went from 101.40 all the way up to 102.01. So that's 61 basis points it swung. Now, it's coming back down because that money jumps in there and they kind of get their feet underneath. It's like, wait a minute, they haven't bought it yet. So if you look back, what I've been saying, to get past this line, they're going to have to do some sort of form of quantitative easing. That's exactly what that is. Now, they haven't put the money in yet. They're just talking about doing it. Look at what's happened. The market is getting frenzied up for it. Now, if you look all the way back, now this is going to take me a second here, and I'm not going to bore you with the scroll. If you look all the way back, actually, let me go back to here. Let me share this with you real quick. Now, it's going to take, this is just my opinion. That's going to be the market, and the conversation about it, all stuff will keep buying until they hit this. And it's probably going to just bounce on that line right there, the 102.52. It's going to hover there and keep beating on it until the actual introduction of capital from the Fed. That's my anticipation. Why do I anticipate that? Well, let's take a quick look why I would anticipate that. So I can show you guys what happened in the charts way the hell back in 2008 and 2009. This is what I drew those charts over. So I'm going to do another screen share here. Okay, here we go. This is the date they announced quantitative easing, which was November 25th, 2008. They announced quantitative easing. This was the open right here. And then it dropped down, but then it rocketed all the way up here at the announcement of quantitative easing, and then it pulled back. Oh, sorry. I'm sitting here showing you guys all the shit. I'm sorry. And I didn't hit the share button. So opened here. It had come down to this point right there. You can see where that line is. Kind of hard for you guys to see. Let me zoom in a little bit more for you. All right. It had come down this far, and then it rocketed all the way up here and worked its way back down. That was a close. That is the channel I'm showing you. It keeps beating on the top of it because this is the day they announced quantitative easing. But after that announcement, there's been a lot of trading above it, right? See all that trading above it? But there really wasn't anything that broke too far above it. This line, which is the line that was established the day they actually started quantitative easing. This is where it started. So anything from here to here is going to be all, my opinion, prior to the actual injection of capital. And then we're going to see that. And this is what happened with it. Now, this also know that this is injecting the capital we're showing here. And I'm going to have to bring this all down so you can view it. Everything above here had to do with the market being influenced by the Fed shoving money in through quantitative easing, taking it from the U.S. Treasury. This is when Trump got elected the first time. Saw the negative response because it was stocks were going through the roof. Money was leaving. They were actually trying to do a bit of a quantitative tightening. That didn't work out. So we had to go back into the taper tantrum. Had right here, we had COVID, massive decline, massive injected of capital, and then quantitative tightening. Then we see where it all fell off. They kept tightening, kept breaking through that. We have the channel that I drew. Here we go. Hit it, hit it, hit it. We're breaking through it finally. How are we breaking through it? And we're going to go up to this point. This is all going to be traders' capital before the actual injection of capital. That's my guess based upon history. I'm the only one looking at it, but that's my guess. It's going to be traders putting money in, but that's going to be the value prior to the actual injection of capital by the Fed. That's my guess. But also remember, we're not going to be able to get, the Fed may be calling, Trump's probably calling for it and saying, let's get this done. His representatives, whoever they are, don't know who those guys are. But we have Powell leaving as the chairman after the first quarter of this year. They're going to be putting a new chairman in. That could be when they do that. That's just my guess. We'll see if I'm right at guessing on this stuff. But everybody's trying to guess on other things that are pushing the market. These are the things that push the market. Where is the money flowing? $200 billion is being considered to be allocated, or at least being pushed over there. That's what broke that. Finally broke that. So we'll see how this plays out, but it's exactly as I've been claiming. I've been sitting here screaming it for years. It's playing out exactly as we said. So we'll see how this goes. It's going to be an interesting roller coaster ride, guys. Welcome to 2026. Oh, don't forget, this is coming out. QuitJerkingOff.com is where you got to go. QuitJerkingOff.com gets you on the order list to pre-order it. It's going to be hitting stores on the 13th. Next week, guys, Tuesday. And then on the 22nd, I'm going to come back and hit you again to get the $1.99 ebook on Amazon. So we're going to push that bestseller thing. Appreciate you. Talk to you soon.